today we're talking about why risk is important in your long-term financial planning portfolio. But before we give you the reasons why it is important, let's talk about risk. Risk can mean a wide variety of different things, but in our context, it's all about volatility. High risk equals high volatility, and low risk equals low volatility. So what does it mean in simple terms? Basically means that if you look at high risk, there's a greater chance and a higher likelihood of a great return on the upside, but also on the downside, there's a risk that you could lose value, especially over the short term. Let's look at some of the asset classes that we typically use in a portfolio, and we'll break it down in terms of high, moderate, and low risk. So your high risk assets are typically equities, which could be local or offshore, and then also listed property shares, which could also be local or offshore. When you look at medium or moderate risk, we typically are looking at local bonds or local debt instruments. When you look at the lower risk band and the lower risk category, it's typically your local cash or offshore cash, as well as your offshore bonds and debt instruments, especially in first world countries. So what we are saying in essence is that when you look at your long-term goals, then you should consider more riskier assets such as equities. We know in financial planning that historic returns aren't necessarily an indicator of future returns, but we also have a long time worth of data, like 100 plus years of data to consider and to look at. And if you look at the data, you'll see that equities and your higher risk assets have provided a real good return over the long term. Let's take South Africa as a case in point. Over the last 10 years, if you break it down, from 2010, local equities on the JSE performed quite well for a 5-year period to 2015. But then from 2015 to 2020, it was fairly flat, moving sideways on the JSE, meaning not really a lot of growth and value. Yet, over the last 2 months, we've seen some great returns again, and that has elevated and lifted portfolios again up to a very acceptable level. So what does that mean? It means that the long-term investor who was patient through this process got rewarded at the end. And that's what we're basically saying today is if you have a long-term horizon, then it is definitely something to consider. Another reason why it is important asset to consider, especially over the long term, is the fact that your equities in particular provide you with capital growth. And capital growth does not come in a straight line. So it's not such as interest, which you know for a fact every month you'll earn your interest. So the analogy that I use to explain this is to say it's like someone playing with a yo-yo on an escalator. So an escalator will wind up slowly, and the yo-yo in the person's hand will obviously, if you play with it on the escalator, will go up and down. So let's say your investment value is the yo-yo itself. Then over the short term, as you traverse upwards, that yo-yo will go up and down quite rapidly. At some stages, it might stay down for a while and then go up again, but it will not move in a straight line. It will go up and down and provide you with quite a bumpy ride. There's a story in our practice, not a story, it's actual fact. It's something that happened with one of our clients, which I'd like to share also with you today. So he came to visit one of our financial planners, and he's been a client for like 15 years. So he's well on his way with his long-term financial planning. But his personal assistant at work came to see him not long ago, and she had trouble in her portfolio. She worked for 35 years to that point at the company, contributing 20% of her salary into the company pension fund. Upon further investigation, our client discovered that she actually invested into the most conservative fund, which in this case was the money market fund, for the whole 35 years. So even though she contributed 20% of her hard-earned money, which is a high percentage, And you would expect that someone contributing that amount would be well away for retirement. But even though she contributed that, she weren't able to retire just because of the asset types and the money market cash component, which was a low-risk asset that she had in her portfolio. So that just illustrates my point. Why, for your long-term goals, you need to consider more risk and why it's important to do so. In summary, you can choose a very smooth ride, which could lead to a poor retirement. Or you can choose for a bumpy ride, but it could lead to a really good retirement, potentially. And that means incorporating more risk into your long-term financial planning.